Hey, everybody, it is 2025, and the market ended 2024 on a high note. Not only 2024, but 2023 as well. Between the 2 years, the S&P 500 is up about 50%. Talk about a nice rebound from the 2022 bear market. But there are still some great values to be found in the market, some great opportunities. We're going to talk about two of our favorite cheap stocks to buy right now. Before we do, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. It's the best way to support this work we're doing on YouTube. Again, fool.com/Frankel. So Tyler Crowe is joining me. And in true Tyler style, he's going to talk about a stock that even he told me you've never heard of this one. So, Tyler, what is your favorite value or cheap stock to buy right now?
Okay. Well, not a lot of people have heard about it because there's only one guy on Wall Street who even follows it. It's called Mueller Industries. The ticker is MLI. Um, the best way to explain it is anything that involves copper or brass, they probably make it. It's basically called extrusion and forming. So, like when you make copper from the raw product into a pipe, that's called extrusion. So basically, yeah, they make copper pipes, they make brass pipes, they do industrial metal fixings, basically anything involving plumbing, HVAC, construction. Very much in that sort of realm, refrigeration, industrial manufacturing, which again, I know it sounds boring, ho hum, whatever. The guy's talking about copper or something stupid like that again, right? But look, I wonder what kind of construction these days requires lots of HVAC and liquid cooling systems that, I don't know, might require copper piping. I don't know, what? Data centers? Huh. What a concept. I think that, there's a lot of these kind of picks and shovels ideas in the background where, look, like, I'm not going to say that Mueller Industries is an AI play, but, a rising tide lifts all boats. If we're going to see elevated construction and manufacturing and and advanced technologies that require like sophisticated HVAC and plumbing systems to actually operate the building, obviously that's going to be an uptick on things like HVAC systems that require copper piping, and so it's kind of a nice little uplift for Mueller. Um, the thing that I actually like about the business, like, yeah, that's a nice little uplift, but this is an exceptionally run business, and that would be the reason that I invest in this company first. I think the AI thing is a little bit of the hook. Um, for more than 30 years, this company's management has had a return on invested capital of greater than 10%. And that includes like construction recessions of like the 2000s and the Great Recession, where construction, like if you look at the 2010s, residential construction was practically nothing for the early 2010s after the great collapse. And yet this was a company still cranking out double-digit returns on invested capital. Today, I think its returns on invested capital are in like the mid 20% range. So very, very well-run business. Management uses substantially all of its like free cash flow to make small bolt-on acquisitions, tends to like buy the people that make the things out of the products that they make. So they go like downstream into making more like, I don't know, flanges and manifolds out of copper for the construction industry and things like that, to kind of get a little bit of uplift in value from the value add products. It's a nice strategy. It's been able to grow earnings at greater than double-digit rates for quite some time. But the thing that's really attractive to me is over the past 5 years, they started kind of taking their dividend more seriously. They paid like a kind of a very, very small dividend, didn't change much for much of the 2010s. But over the past 5 years, they've grown their dividend at 30% annually. And it's only a 1% yield, but look, if you're going to grow at 30%, I'll take a 1% yield. That's a nice little trade-off there. And all of this is currently trading at 15 times earnings. I think there might be some concerns on like a pull forward in construction demand that maybe might not last if, I don't know, ever some of these like hyperscalers like Amazon or Google or whoever else starts to decide like maybe we're going to tamper back our data center construction build out for all this AI modeling. That's a very legitimate possibility. But I think that it's spread out enough across all of the other things like residential, other construction, uh, semiconductor manufacturing. There's a lot of other like advanced manufacturing that's being built in the United States today that's going to require advanced HVAC systems. So I think you put that all together. I think this is a pretty compelling value at its current price, despite what may look like a, a, a a slowdown in a couple of years, or at least a possible one.
So I want to talk about one that is not a traditional value stock, but I think it's really cheap right now, and even more than its price suggests. And its ticker symbol is very similar. We didn't plan it this way, but I'm talking about Mercado Libre, ticker symbol MELI. It is actually my third largest investment at the moment. It was my largest at one point, but the stock is down about 20% since it issued its third quarter earnings. Now, the business itself, at first glance, is doing really well. There's two main sides to Mercado Libre's business: the e-commerce marketplace, and then their fintech business. On the marketplace side, they 20% more items sold in the third quarter than a year ago. They added 10 million active buyers to the platform over the past year. On the fintech side, which is called Mercado Pago, think of them as like a Square or Block or whatever they want to call themselves now. That the payment volume was up about 35% year over year. They now process over $200 billion in annual payment volume. They have a credit business within the fintech business that's growing very quickly. Also one of their biggest risk factors, but we'll get to that in a minute. The credit portfolio is up by 77% to $6 billion. So at first glance, the business is growing really well. The big concern and the reason it's down so much is profitability. Profitability and perceived risk. So their EBITDA margin was down by about 7 percentage points year over year in the third quarter. And they claimed that the reason they were not that profitable is because they're investing a lot more in their own growth, which, to be fair, with 20% plus growth rates in the business, that's usually an acceptable excuse. But when you dig into the numbers a little bit more, the reason their margins were down so much, it's almost an equal combination of investments in growth, like they said, and losses due to bad debts. The latter is not a good reason. Things like credit card losses and like small business loans that were unpaid and things like that, which as you grow a credit business, that's going to happen. The question is, where does that kind of level off? Is it going to get worse? Is it going to get better? As Tyler and I discussed before the show, their biggest market is Brazil. Their economy is not exactly the most stable right now. I wouldn't call it it's not Argentina 2 years ago, but Brazil is not the most stable economy. They're dealing with inflation. If you look at the exchange rates, it's kind of fluctuated a whole lot. Argentina is their number 2 market, and talk about inflation. Their inflation rate in 2025 is down to 26%. So, there are a lot of perceived risks here that are very valid concerns. But for me, the risk reward of this stock kind of really outweighs that. There are a few long-term tailwinds I'm watching. The obvious one is e-commerce penetration. Believe it or not, only 16% of U.S. retail sales are e-commerce. That percentage is much lower in the markets where Mercado Libre operates. The biggest kind of roadblock to getting to a U.S. level of e-commerce adoption is logistics, which Mercado Libre has its own logistics platform. As that makes advances, it'll bring a lot more sellers into the e-commerce ecosystem. So that's going to be a nice tailwind over the next 5-10 years. There's still low rates of cashless payment adoption compared to the U.S. We don't think of that. I'm taking my kids to a basketball game tonight, and the stadium is entirely cashless. That's not really a thing in some other parts of the world, to go into a completely cashless environment. So there's that. It's a big market opportunity. They're expanding quickly in other Latin American markets. In Latin America, there's 650 million people, roughly double that of the U.S. So big market opportunity just in their home area. And there's a lot of early stage businesses within Mercado Libre that aren't getting as much attention as they should. I know every company with data is starting an ad platform, but Amazon has had tremendous success with it. Mercado Libre launched Mercado Ads not that long ago. It's already growing very, very fast. They have the Meli Plus premium package. Think of that as like the Amazon Prime equivalent, that just introduced a 2-tiered pricing structure with a low-cost option to bring more subscribers in. They have a credit card business, which is, not everyone in these Latin American countries have a credit card in their wallet the way that most people do in America. They have their own investment platform. They have an insurance tech business. I could go on, but there's a lot of things that could become bigger parts of the business that are right now growing very, very rapidly. They could keep those 28, 34% top line growth rates in their business really sustainable for years to come. So, at right now they're trading at a price to sales valuation that's about 64% less than before the COVID boom. So not even like, looking into the COVID years. So 5 years ago, they were trading at much higher price to sales. They're trading for less than 15 times free cash flow. Again, not without risks, not saying that at all. Brazil's economy is definitely something to keep an eye on. But at these levels, I think the risk reward makes a whole lot of sense. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.